So it is good. So it is good to try to find what's driving a bull market, and that way you get a feel too if those things are changing or coming to an end. So that's the basically your 50-200. So like I say, what I want to see here is this 50-day cross back over the 200, and that's going to give me on my spreadsheet, I give that so many points, and that's going to bring my overall bull bear kind of number up a little bit. The other one I mentioned about, I think I've mentioned in 2 videos now, is the 12-month rate of, and I should say everything I'm doing here is on the S&P 500. I don't really analyze the TSX that much. Basically the TSX will move, is correlated pretty closely with the S&P 500. I just find with the S&P 500 there's so much more data available to analyze it. The States has lots of problems, but one thing it does have is a lot of information that's available for next to no cost. Even on companies through Edgar's site, you can get every filing for free. And even though I hate the Fed and think they're a big part of the problem, you can get all the data from the Fed, and like graphs I'll be showing you later, graphs I've shown you before. Pretty simple to make up a spreadsheet, put the Fed ad into it, and then you can download data directly to your spreadsheet. Like I say, I've got 50 some odd charts that I can look at within less than an hour. So, so this 12-month ROC, I won't go through the formula for it, but it's basically looking at a price 12 months ago and then moving along and smoothing it out. So, pull it up, and it didn't come up. Well, there it is. So this very simple kind of oscillator has worked for decades, and again, it can give you a couple false signals, but it hasn't given a full sell signal this whole 11 years. We dipped below the 0 line, but we never got below the -20. So what I said on this one is when it goes to -20 and then back above -20, that's a buy signal. And right now we've gone from +30 down to about -15, and we haven't reached that -20 mark yet. But the way the market's falling, I expect that to happen pretty soon, and then I'd just be watching for that to come back up and go above -20, and that would, again, on my spreadsheet, this counts for so many points, I would give that maybe an 80% rating then, and move that. It's just another kind of buy signal. So you kind of combine these, and once you get a combination of them all giving you a buy signal, then you get kind of get back in. And it's nice to know that these have worked for, like I say, decades. So, and I'll show you again, we can see that actually very strongly in 2009. We were up at the +20, went all the way down to -40, which is quite extreme, and then we came back up, and there's -20. So if I show you here where that happened, -20, you would have got into the bull market here. You would have missed the first leg up, but then you probably could have stayed in all the way. So you would have captured about 80% of this run, and we've only now, looks like we're going to get a sell signal. So this one is really good, just to sit back and say, oh, well, everything's kind of fine. Like I say, there was a bit of chatter here where it went below 0, but it never went to -20. So this signal here, you would have captured 80%, and of course you would have lost a lot here because it's taken a little bit of time to respond. So because I knew it was the end of a bull market, I did act earlier like at -5, -10%, and sold out a little bit quicker. But now I'll be watching this for a buy signal, and say I want to see that come, first of all, get below -20 and then come back. And there's a good chance as this goes on, it's looking like this correction is going to be worse than 2009. We're seeing economic data that's just collapsing. You see, everything's shutting down around the world, so this bear market could turn into an 80% correction. I'm thinking at least 50, but again, it's pointless to kind of speculate. You just want to use the tools that you have and kind of keep updating them and getting a feel that way. So that's basically a very good one that I like to look at. Another one is what's happening within the market. And as not all the money can come out of the market, so it will move to safer locations within the market. Pension funds, large mutual funds, they have policies where they have to be so much in equities. Maybe they have to be in a range of 20 to 40% equities, right? So maybe they sell down to 20%, but they still got to keep. There's only so many places you can put money, right? There's bonds, there's equity, and then there's the private kind of venture capital type world or infrastructure type world through government. So one thing that we've all seen is people now, when we go out, what we go out for is basically to shop for groceries. So those type of things are called consumer staples, basically things you need to live. And so it's bearish. Usually in a bull market you'll see consumer cyclicals, like people buying cars, other things like that. And we've seen this is basically the consumer staple ETF divided by the S&P 500. So as a consumer staple sector, more money goes there, the index goes up, and this chart goes up. And we've just seen now this really kind of take off as money now is rotating into the market to consumer staples. So that's another bearish sign. All the ones I'm going to show you today are negative. So there's none even giving me a sign of hope yet that we've reached the bottom of the market. So another one is advanced decline ratios. This one, it's not the best. It typically lags, but it's things such as this is the advanced decline ratio. So there's more stocks that are declining, the ratio comes down, and we can see there is a moving average in here because this is so choppy, it's almost impossible to read, so you got to put a moving average on it. And you can see here that there's a lot more stocks declining than advancing, of course, but we still haven't reached where we were in 2009, but we should see that shortly. There's ones for volume too. That one's not the best. So this is down volume. So down volume is if a share, say, drops $1 and that company has 100 shares, and the down volume is going to be 100 shares. So it's just and if another company has 100 shares and it's up $1, then they just aggregate the two. So it just gives you the overall sales volume. And we can see this has just skyrocketed, going right up. So the downside volume is still very high and not really decreasing yet. And that still hasn't reached the 2009 peak. So on price changes and volume, that's still negative. Another thing is actual bear market rallies. What I will do is go back to my back to this chart here, and basically the market doesn't go down and then come straight back up. If it's a bear market, it's going to come down, people are going to get some hope, it's going to come up, and then there's going to be the next wave of bad news taking the market down again, and then there's going to be some other hope. So there's never been a bear market where it's basically just kind of gone down and came back up in a V shape. So we've really only had one major leg down, and it was so violent. This is the quickest the market has dropped. We had a 20% correction, I think I mentioned it a few videos ago, in about 20 days. Usually it takes about 134 or 137 days to get a 20% correction. So this was profoundly violent, and now to expect that to be violent the other way and just come right up and make a new high with the current situation we're in is just ridiculous, in my opinion, and it's never happened. So we have now had one rally up, which we've experienced over the last week or week and a half, where we have basically a 16% gain. And a lot of people are thinking, oh, now I'm bullish, the market's taken everything into account, sunny skies from here. Like I say, that's never happened before, so what are the odds of it happening this time? In 2009, we basically had 6 legs, up, down, up, down, up, down. The year 2000, we had 6, where we had 6